According to the World Gold Council, in 2022, central banks around the world bought more gold than any time in history, and the massive gold purchases in 2023 are now likely to exceed the previous year. Do central banks know something we don't? To make sense of this present economic environment, we will hear from economist and investor Keith Weiner and macro analyst and investor Lyn Alden.
Basically, it's got the highest stock-to-flow ratio, meaning that the amount of gold that's out there in human possession, the flow of new gold is very low compared to the existing stock. So it's like 1.5% per year, roughly, and it's a pretty stable number in any given kind of multi-decade period. And what that means is that we don't dilute the amount of gold very quickly. In fact, it's been roughly in line with population growth historically, which doesn't really have to be the case, but just roughly has been. And so really, if you hold a gold coin, your rate of getting diluted in terms of your share of all gold that exists is very, very slow compared to many other monies, compared to many other commodities. Basically, as humans gain more technology, so as we went through the Industrial Revolution, or even before then, just as we got more metal tooling, went through those different eras of monetary technology, we got way better at making certain types of money, and we basically broke their stock-to-flow ratio. So if we find out that some culture uses shells as money, and we have metal tools and like more advanced boats and things like that, we can go and industrialize the process and just flood them with money and get whatever they were willing to sell that's scarcer.
Gold has been doing what it does for 5,000 years, and the proposition is that it's going to continue doing for the next 100 years what it's been doing for 5,000 years. We live in a system where we have a failing dollar. This is a feature, not a bug. The dollar is designed to go down. The Fed on its website says 2% per year, which they define as price stability. I wonder what Orwell would be saying about that. So the dollar is designed to go down at a steady rate. Why? As a free boon to borrowers. If you borrow money and then the dollar is going down, then what you owe the return of is falling in value. The longer the term of the loan, the greater the fall, the easier the burden on the debtors. And that is how the system, if I can use the word rigged, is rigged. Unfortunately, the dollar doesn't do as they would wish, doesn't do as their theory would predict, and it isn't steady or stable. It is not a simple mechanism for robbing Peter to pay Paul, Peter being the lender on the other. So every trade has two sides. And there's Peter over here who's the saver who's lending his savings to something and expecting to get that back with interest. Well, he's the one who's screwed when the dollar goes down, and then Paul over here, the borrower, is the one who wins when the dollar goes down. Unfortunately for Paul, it isn't a steady, linear, monotonic, would be the term, progression of going down. It has wicked volatility to it. And as we see right now, the dollar is going up, not down, which means the borrowers are finding that their burden of debt is increasing, not decreasing. Oops. So savers, when they face this uncertainty, turn to the thing that they've turned to for 5,000 years, which is gold. It doesn't have a risk. It's the thing you have when you don't want to invest or speculate and take a risk.
But what makes gold unique, and to some extent gold and silver, but especially gold, is that we, even with our modern technology, we still can't make it quickly. Even during the 1970s, when the gold price in dollars went up by an order of magnitude, if you just look at the percent annual supply growth of gold, so not just the absolute tonnage, but the new tonnage compared to the estimated existing tonnage, you won't really notice the 70s on the chart looking any different than the 60s or the 80s or any other decade within the century. Basically, it's one of those commodities where the price only slowly and not hugely affects how much we get out of the ground, and that's because it's so energy intensive per ounce. It's hard to find and develop deposits. And there's a natural difficulty adjustment. So as over time, as our technology is better, we get better at mining gold, but also the easy deposits are already mined. I mean, basically humans have spent thousands of years finding gold. And so the deepest and most challenging deposits remain. And so even as our technology does get better, that's not really translated into us being able to break that money in a similar way that we can break almost any other money, with the exception of these kind of more like very rare ones.
The famous economist Milton Friedman once said, "Inflation is taxation without legislation. Policymakers, institutions, and governments may decide the fate of our currency. It is our responsibility to safeguard the wealth we have, because no one else is going to do it for us." If you are interested in protecting your retirement savings and preserving your purchasing power through a tax-deferred Gold IRA, see the links in the video description. To attend a free Gold Education webinar held by Augusta Precious Metals, see the link in the video description. Thank you for watching.